Good morning and a warm welcome to all of you who've managed to join our session today. We are happy to take you through the session on budgeting and strategy checkpoint. My name is Kenon Bae, your Chief Value Officer, and I'll be happy to take you through this session. We just had a session on strategy. So how does that connect to budgeting? Before we go into the details of budgeting, so ideally, budgets are actually derived from strategy. The strategy will be a longer term document, 3 years, 5 years. Then out of that, every year you break down that into a more detailed document, which is the budget. Budgets will definitely ideally cover a year. When flowing from a strategy down to a budget, the factors we need to consider is we need to make sure we continuously gather market intelligence. Things are changing very fast. So it's important that we always make sure we're on the ground, understanding our industry, what changes are there, what are the trends to make sure that we're on it. We need to build strong business relationships and partnerships with all stakeholders. These are continuous process because businesses, again, work from either dealing with other businesses or dealing with individuals. It's important to keep that going. Lastly, is remain resilient. I have full respect for every business that opens their doors one extra day because it's cutthroat, it's difficult, it's challenging. So it's important to always remain resilient as running our business. So again, I just have a few slides around budgeting, just to have a formal direction on this, that a budget is a financial plan that you estimate your revenues in the future. So next year, 2022, I expect my revenues to be X. You also estimate your expenses and related cash flows, and usually for a period of a year. In terms of the process itself, the budget process starts by planning. Ideally, best practice is to start your budgeting process before the year starts. I know we're already in 2022. We had this session earlier on in the year, but ideally the budget for 2022 should be set before the year starts. But even if you haven't set your own budget, it doesn't matter much, you can always catch up. But the ideal thing is to plan and focus long before the budget period comes in. After that, you go in and implement the budget. That is, it's the revenues you're chasing, you go for them, whatever initiatives you've taken, you take them. After that, you keep monitoring and controlling your budget. That means every so often, ideally every month, you sit back and check. I had hoped to be at this position at the end of February. Where am I? What can I do differently? What needs to change? That is all around monitoring and evaluating and controlling. And lastly, you evaluate your performance. Usually happens at the end of the year. So finally, after all is said and done, how did I do in terms of the entire budget? The budgeting process, you take two approaches. The top-down and the bottom-up. The top-down business budgeting approach is where the senior management determines the level of operation they want to reach in terms of what revenues do you want to make, how much cost do you want to spend. Then they'll go to their teams and tell them, this is the proposed budget. Let's discuss how best we can meet these figures. That is a top-down approach. Obviously, it has its own advantages and disadvantages. A clear advantage is we are sure we are going to hit our budget. If the figure is 10,000, we are not dilly-dallying on that one. We just have to make it happen. And again, another advantage, it takes a very short time. The budget is there, let's all work with it and move on. The disadvantage you'll find with the top-down approach is you may not get buy-in if people sometimes feel this is not our budget, it has been imposed on us. So that one we can't quite buy into it. That's a critical thing around top-down budgeting. For the bottom up, this is where the senior management will go to the teams and say, go out and explore. Look at your business environment and propose the figures you feel you are able to meet in the coming year. The teams go out and come with numbers, but those numbers have to be checked against the targets. Remember, when we talk about strategy, there's a direction we want to take. As much as this information is coming from the teams, it still needs to hit a certain target, such that if that target is not met, a discussion will happen. People will still go back and they're told, no, it is not yet enough. Go and explore some more until finally they have a budget that is put together. The obvious advantage with this is that the teams have a buy-in. They know these are my figures. I'm the one who's prepared them. I can support them, and I'm happy to go chase them. The disadvantage is it can take a long time as people are doing back and forth and all these sorts of things. And it might also mean that people may not explore their full potential. If I feel I can do 20 and you feel 15 is okay, we are all okay. So I'm left with something that I haven't achieved my full potential. So looking at budgets, the building blocks for the budgeting process, the first one is revenue. The next one is cost. Third is the profit and loss. And lastly is CAPEX. This is a capital expenditure, and you're going to open up each one of these step by step, but these are the building blocks of a typical budget. Let's start with revenue. The steps that we take when budgeting for revenue is you list all your clients, both existing clients and new clients. Then out of that, you go to your existing clients and determine how much growth do you anticipate. If you have someone who gave you, say, 1 million shillings of business last year, this coming year, how much do you anticipate them to give you? Maybe they'll grow by 5%. So you determine on each of your clients, this one will grow. There are some who actually might decline. They'll say, last year we gave you this, but this next year it looks like we will give you something slightly less. So after that, you look at your new list of clients and you're exploring. You've never dealt with them before. You're just going out to look for new business. How much do you anticipate the new business will give you? So you have your list of clients, you have how much they are going to grow and the volumes you expect from them. You multiply the two with the selling price. That means you have your revenue budget. You have 10 clients, each of them giving you 100,000. You have your revenue budget. But there are critical considerations to make when budgeting for revenue. The first one, we need to apply very well thought out assumptions. What does that mean? If we go out and assume that someone is growing, a client is going to grow by 10%, that assumption needs to be very well thought out. And the reason this happens is, ideally, we start with budgeting for revenues. Based on the revenues that we have, then we decide the costs that we're going to spend. The revenues are harder to come. So if you say, I'm going to get 10 million, and because of that, I'm going to open a branch in Kisumu, the opening of the branch in Kisumu might depend on your ability to meet the 10 million. That's why the revenue numbers and the assumptions have to be very, very well thought out. The second thing is that we need to be ambitious yet realistic. I know as business people, we go out, we want to grow, we want to be big, and that is important. In fact, that's what drives organizations. But it's important that we are realistic in that. So that balance is important to establish between being ambitious and realistic. It's advisable to incorporate a small stretch budget. So if you feel that you can be able to make 10 million, budget for about 12 million, because that extra 2 million will take care of anything that you had not planned for. At the end of the day, you will get a report that looks like this. This is an example of a budget for a hospital where they have the red bar is on the current year, say in this case, 2021, how much did we perform? Then the green bar is for the budget for 2022. So they have their lines of business, consultation, lab, pharmacy, dental, and pediatric. That takes care of the outpatient. They know how much they want to make in each of that. Then for the inpatient, they have their maternity section, oncology, and surgical. This is typically how a report would look like when you finish budgeting for your revenue. Some might grow, some might not grow. Critical thing is that everything is very well explained. That is the first building block. The second one is the costs. Again, the steps are as shown there. You establish your direct cost versus your indirect costs. Simple terms, say for example, someone is in the business of importing cars for sale. So that person, when they go buy a certain vehicle at say 500,000 shillings, and they're going to sell it for 700,000 shillings, that 500,000 is a direct cost, in that it can be directly associated to a certain car. You can say, this is the car that cost me X. So that is a cost that can be directly attributed to a certain item. Indirect cost, on the other hand, back to the same example, if the person ends up paying an electricity bill of 30,000 shillings that month, it might be difficult to say, this vehicle consumed this electricity, the second vehicle. So what happens with indirect costs, you just allocate them, say 40,000, there are 40 cars, so each car must have consumed 1,000, and you close it that way. Having established your direct cost and indirect cost, you go to the indirect costs and now classify them into categories. Are they operational costs? Are they administration costs? Are they finance costs? You categorize them just to be organized. After that, you determine, so for each category, how much am I intending to spend on my admin costs? That is the salaries, the people that you're employing. How much do you intend to spend on your operation costs? How much rent are you going to pay? The printing and stationery, all that goes into running the operations, motor vehicle expenses, etc. Once you do that, you'll have gotten your budget for costs. Again, it's advisable to have a contingency budget because, again, there might be unforeseen expenditures. The nature of the business, don't cut it too close. Leave a small budget to play around with. But looking at the considerations, some of the things that might go wrong is if you don't include all your costs in the budget. So it's important that as you're budgeting for costs, don't fear or don't want the cost to be so low such that you end up either ignoring, disregarding some costs and say that will sort itself out. That is not the right thing to do. Make sure all the costs are in your budget so that you can see the full picture. Again, having a budget does not mean we spend automatically. Because I have a budget for this, it means I spend. No, there is still a process that goes towards the spending because things might change. You realize you thought you'd spend this, but you found another innovative way of doing differently. So again, it's important for us to see that we don't always think because a budget is there, I can automatically spend. All the costs that we are budgeting for should be able to create value. We always say, make sure every cost is like an investment. The idea is not to reduce costs and keep reducing costs, but the idea is that for every shilling you spend, it needs to add value. Add value here means that it either increases your revenue, it either reduces your costs. And then finally, costs are meant to increase efficiency and reduce the turnaround times. One thing that happens in business is the speed at which you do business. How quickly are you able to turn over your back office? That is quite important in terms of budgeting for costs. Once you finish your budgeting for costs, you might have a report that looks like this, that splits your direct costs at say 40% of the total cost, operating costs at 12%, admin costs at 31%, financial expenses at 2%, and other expenses at 15%. Maybe at this point, the thing to mention is that behind all these numbers, there's a whole detail around it that helps support all these numbers. So maybe I can pause at this point and ask if there's any comments or questions on the first two building blocks. The first one, we've dealt with revenue, and now costs. You can feel free to either raise a question or a comment, or just taking a pause before we go to the other two sections to complete the budgeting process. You can either put it on the chat, or you can always speak in the mic.
Okay, Kenan, as we are waiting for maybe a comment, question or two, I'd just like to acknowledge Dennis and Peter, who have joined us in the second session. So please feel most welcome, Dennis and Peter. We had someone else joining. I think they logged out. So please feel free. As you found us discussing, if you have any questions, you can put them on the chat. Karibuni sana. Thank you.
Thank you for that, Melissa. So we'll keep looking out for any questions or comments that come on the chat around cost and the revenue. I see one that has come from Izo. So Izo's question, let me just get that one. Why are other expenses higher than operating expenses for this example? So the answer to that is each organization has its own cost structure. So in this example, it could be they have very many expenses which cannot fit into the classifications here, and then they lump them as other expenses. In this case, maybe for a hospital, they might say that other small things that cannot fit into any of these classes, so we put them under other expenses. So in the example, it's not necessarily hard numbers, but it's because various businesses have the various cost structures in their operations. Okay.
And let me just comment on that, Canon. I've also seen for new businesses that have probably not established what their main cost items are. These are small and new businesses. I've found that they might classify that probably in the beginning as other, and then as they go along, they are able to define what those other expenses are. So maybe they have their operating expenses as maybe 3 or 4 main expenses that they are able to define. Then as they go along, they are able to now shift that from other to more well-defined expenses.
Yeah, thank you. Thank you for that, Melissa. So we'll continue looking out for other questions, but maybe you can go to the third building block of the budgeting process. Remember, we've tackled the revenues, we've tackled the cost. So simple math, revenue minus cost, you get your profit or your loss. But the considerations to make here is, ideally, we should never budget for a loss. By the time you're finished with your budgeting process, it needs to be worked out and tweaked such that the revenues are always above the costs. Of course, there are exceptions where if you're a new business and you are starting off, the most probable thing is revenues may not come as fast. It means the first few months you might record a loss. Afterwards, you record a profit moving forward. That's an example. But either way, you need to remember, if we do not have revenues to cover the cost, then you are financing your business from your pocket, or you're financing it from retained earnings. For businesses that have been here longer, you're digging into the profits you've been making all these years to finance the budget that is coming up as a loss. But the first point is, we keep going back and forth until we have a budget that brings us a profit. Second consideration, it's important for you to know your most profitable line, your profitable branch or your segment, such that if, for example, the branch in the city center is making more money than the branch in Upper Hill, Nairobi, that clarity helps you in the budgeting process. Of course, many questions come in. How can the branch in Upper Hill borrow from the branch in Nairobi city center to also increase its profits? What are the dynamics? If, for example, you want to start a third branch on Mombasa Road, will it be profitable or will it not be profitable? That is important when budgeting for your profit or loss, because sometimes you've seen businesses where if you don't have that clarity, you are doing you have a number of businesses running, but the loss-making business is eating from the other profit-making businesses. The ideal thing at worst is you need to close the one that is making losses or improve it. But until you get to see that clarity, then you cannot be able to make that decision. It could be even around your products. You probably have a number of products that you're running, but you're not too clear which one is profitable, or even the level of the profitability. That is quite important when looking at your final profit or loss budget. The last comment around this is it's important for the budget to have an owner. What that means is if you're a small organization and you don't have many employees, you're probably responsible for the revenues and the costs. That's okay. You will need to own those numbers. Once you own those numbers, you sign off on them and you take responsibility in delivering the numbers. Because remember, we are building a company. There's a strategy we are all chasing. So the people, the process, the people, the structure, the systems, and the alignment has to work every time. If you're a big organization, of course, you probably have various people who own these budget numbers. Each of them has to sign off on these numbers. Once you're done with the profit and loss budget, it will look something like this. The red line is expenditure. The green line is the revenues. We notice that at all times, the revenues must be higher than the costs. So the last section around budgeting is on the capital expenditure, which we call CAPEX. These are...
Kenan, may I interrupt just kindly?
Yes, please.
I think just to take you back a little, and you may decide whether to respond to this now or after the CAPEX session. We had two questions, one from Isaiah, and maybe I'm thinking we could actually respond to this after your CAPEX session. So Isaiah was asking, just one moment, that when making an ideal budget for a startup or a new business, how would you estimate the revenue without prior experience? I think that's a very, very important question.
Okay. How
would you estimate the revenue without prior experience? And then Jane was taking you back to a comment you made, and I think it was on the point of don't make a budget with a loss in mind. And she asked, kindly expound on where you said that, on the use of retained earnings, that one may end up using retained earnings.
Okay.
Then Enid is saying you may be a bit fast.
Okay.
Yes.
Okay. All right. Thank you for those comments. So let's start with Enid's comment. I will endeavor to slow down as much as possible, but also to remind Enid and every participant, one, we are going to provide this material after the session. We're going to do a friendly version which you can share with you. Then the second comment is that we are available to actually take you through in detail on a one-on-one on areas that you might need more expounding. We just realized that in a 2-hour session, we may not be able to cover much, but I'll try as much as possible, go slower. I think it's best to answer these two questions that have come in. Let's start with Isaiah's question. Now you're a startup, you have no experience, you're going to start a new business. I think let's take one step back. If you go back to the strategy session we started with, there are 3 things every business needs to be aware of. You need to understand your strategic position. You need to understand your strategic choices, and then you come to implement your strategy. So this question will be best answered at the point. A lot of thought needs to go in a new business. When you go to your own environment, even before you start opening the first day of your business, a lot must have happened beforehand to convince you that you actually can go into this business as a basic. So in terms of estimating the revenue without prior experience, it is important that you understand the business you're going into. Yes, I would agree it is a new business, but as a business owner, you need to have basic information of where you're going into. Sources where you can get revenue or numbers. I have friends who, I have a friend who was trying to start a small business. They were doing cake business, and they didn't know what to do when starting this cake business. There's a bit of it that they took a risk. I mean, they went around and saw how much are cakes being sold at Naivas, how much are cakes being sold by my next door neighbor, how much are cakes being sold by the Mama Mboga. Based on that, they realized, okay, fine. So I think I can position myself somewhere in the middle. There he got his pricing budget. Then he started estimating how much do I think I can get from the people. He looked at the position of his shop. So there's a place where he endeavored to study his environment, to study his competition, to study the trends. By the time he was opening the shop, for sure, he was not 100% sure. There's an element where he went in just to see if it's going to work or not. But he had done most of the homework to know he's not operating too far off from his environment. So even without prior knowledge, it's important to be sure that you know where you are at. You gather as much information as you can about the business or the sector you want to get into. But I would think there's an element of let us actually try and see if it works. There's a risk element. You cannot be 100% sure as you're going in. I believe, Isaiah, that answers your question, but I'm happy to take up a follow-up discussion around that. The question from Jane Wagema to expound retained earnings. Maybe let me explain this a little bit more. So for a new business that is operating, you're starting with selling things in the first year. You make your profit or you make your loss in the first year. Once you close that year, because what happens, you close your accounts every year, you close that and you say the year 2021, I made a profit of 220,000 and I've closed that. You file those returns with the regulator and you close that. When you come to the year 2022, the profits that you made in the prior year are called retained earnings, assuming you didn't consume the money. That year you made to 20,000 and it's sitting in your bank. So when you're starting the following year, you're not starting at zero. You're starting with, there are some profits I made in the last year and they're still in the bank. That is what is called retained earnings. So when I say you use retained earnings is, say in the year 2022, you want to open a new branch. This new branch in the first 6 months will not bring you any much revenue, but you need to pay for your rent cost. You'd probably need to pay for a shop attendant. So the money to pay that shop attendant and to pay the rent for the month of January 2022 is not available because the branch in Kisumu has not started making money. Ideally, these 220,000 shilling profit you made last year that's in the bank is what you're going to use to pay the January rent, February rent, until the Kisumu branch starts to bring in its own revenue and pay its own costs. So that's what I meant by you intend to use retained earnings. A standalone branch or line of business or product has to make its own money on its own. But practically speaking, you might start off with a loss before the business peaks. So I believe that that has been expounded, Jane, but again, I'll be happy to take it up. Thank you, Isaiah, for your acknowledgement on that it's well understood. Thank you, Jane. You acknowledge that you've understood the retained earnings question. Okay, so let me recap just a little bit for its sake. When doing revenues, you list your clients, both existing and new. For the existing clients, you determine how much they're going to grow or decline. For the new clients, you estimate how much you're going to get from them. You multiply your number of clients times your volumes, times your selling price, you get your revenue budget. For the costs, you establish your cost structure. What are the direct costs? What are the indirect costs? For the indirect cost, you classify them further into the various categories and determine how much you're going to spend. And you'll have a graph that looks like that. After that, you've already gotten your revenues, you've gotten your cost, you have your profit and loss. Always ensure that you're making a profit at every time you sign off a budget, unless you need to give time for that branch or that new business segment to take over. Okay, we'll still look out for more questions as they come. So the last building block on the budgeting process is what we call capital expenditure. Capital expenditure means buying items that you'll use in your business for typically more than 1 year. Say, for example, Isaiah is an accountant in an engineering firm. So as part of the engineering firm, they probably want to branch out and start off a branch in Mombasa County. So his company needs to think through, they need to get office space, they need to pay for the rent and the deposit, they need to buy furniture, they need to buy computers, they probably need to do a small marketing effort to have the people know that they're in Mombasa. That is not a normal day-to-day operation. That is an exception that they do once in a while. That is now an example of a capital expenditure budget. Another example is, think about a dentist. A dentist has his own dentistry chair. That chair for the dentist uses is quite expensive. But also it depends on, by the time they finish, they get more and more customers and they realize they need to buy a second chair. That is a capital expenditure in its nature because it's a one-off expense. The chair they're going to buy, they're going to use for a longer period of time. So that is the difference between the normal budgeting we've done for revenues and costs that happen every so often versus the capital expenditure. Now, the steps that we take when we are doing the capital expenditure budget is we need to review the business needs for the budget period. Like I've said, in the example of the engineering company that is opening a branch in Mombasa, you check, now that I'm going to open a branch in Mombasa, this will be my needs in the year 2022. If you go to my friend who is baking cakes, they're looking next year, they want now to, in addition to baking cakes, they want to start making fast food, chips, sausages, and the rest. It means then they need to think, we need to buy a fryer, we need to get a place that has three-phase electricity. Those are reviewing the business needs for the budgeting period. If you're in the e-commerce space, you're thinking, what do I need to do next year? What are my budgeting needs for next in terms of capital expenditure? Maybe you realize in your e-commerce business, you've been trading on and on, but you need to upgrade your entire platform to give customers an opportunity to interact with you real time. That means you need to go to the product developers and they need to develop a whole platform for you. Of course, that platform you'll get to use it over a period of time. That's what you're saying. You need to review your business needs depending on the business that you're in. Of course, you factor in business expansion, you've already taken care of that. But it's important to obtain good quotations. Capital expenditure in its nature is expensive. So don't be in a hurry to quickly just buy something that's available. It's important for you to do proper market research, go wide, understand the market and see that you're getting the best deal. Not only the best deal in terms of money, it also could be the best deal in terms of, are you getting enough warranty on the products you're using? Are they the good quality? What is the after sales service? Do you have someone to support you after you buy? It could be, is it compatible with our market? So it is important to pay close attention that by the time you're spending on your capital expenditure, you have done your homework. The considerations to make when doing capital expenditure is you need to have the funds. You know, it is one thing to want to, for a dentist to want to buy a new chair, but does he have the money in the bank? Capital expenditure is based on the money in the bank. Remember, you've been making profits all this time, but maybe there are some clients who have not paid you. So it means, yes, you've made profits, but the money is not yet in the bank. So you cannot have money to go and buy your capital expenditure. So what that means is you probably have to look for funds either from a financier or from another source, but it's important to ensure that all funds are available. Now, there's something called end of life of an asset. When we say that you verify that the existing assets have reached end of life, maybe what I can do is I can give an example with a cell phone. All of us have a cell phone. Now, most probably you have changed your phone once in a while. So the question is, why did you buy a new phone? Is it because the one that you have is broken and can't work anymore? Is it because a new brand has come, so you want to actually get the advantages of a new brand? Is it because you feel you just want a better phone and a bigger phone? So all these are examples. When you're replacing that phone, has it reached its end of life? If you keep your existing phone, can you still continue operating? Now that's important when you're doing capital expenditure. Make sure that by the time you're replacing whatever you're replacing, you have made most use of that. So the two main measures that come out when we are talking about capital expenditure is return on asset. Return on assets basically means, am I getting the most from the asset I've bought? Look at that example of a dentist chair. Has he used the first chair so well that he has gotten all the advantages he needs from that chair before he goes to the next chair? That is what we call return on assets. Return on equity means for every shilling that you spend, how much profits is it going to bring? The example of the engineer who wants to open a branch in Mombasa. It's going to cost money, but it's important that the opening of the branch in Mombasa is going to bring in sufficient profits. So that's about it in the budgeting session. So lastly, I'll take the next few minutes or so to just talk about Mwalimu Biashara. Mwalimu Biashara was set up about 6 years ago. The idea was to provide management consulting services for SMEs in our region, and that has come up well. We are happy about how it has come up. Our focus areas are in business planning. This is where we help new businesses make their business plans. And I think a question like that came from Isaiah, where he talked about how can a new business understand its revenues without any prior experience. So that's our entire focus area, not only for new businesses, even for existing businesses that want to venture out into new products or new geographical areas. That is an area that we are comfortable, and we are ready, and we have what it takes to help you plan for new ventures that way. Second one is on strategy formulation and implementation. This is basically what we have centered on today. We picked this as one of the areas we wanted to open it up, and I think the presentation is well explanatory. So we can sit with the organization. First, we can help you formulate a strategy, or if you have an existing one, we can help you improve it. And then also we can handhold you to implement it. The ideal thing we do is that we sit with the organization for a period of, say, 3 to 6 months, where we help your team understand, absorb what strategy is, change the right cultures, and have everybody pointing the right direction. Then we leave it up with you and your team to take it over, because again, it's a long-term document. We do financial modeling, business planning, and management. This is where we help you link all the figures. The question that has come around accounting skills, this is where it sits. We have set up a whole accounting back office, which can give our clients. If you want to automate your accounting processes, we are able to automate your functions. We're able to give you an accounting software, and we've gone to the market and identified the good ones that can suit various businesses. Some of them, you'll be surprised, are available for a very, very low amount, but that's something we do. And after that, we help you plan for the future. You do your forecasting, your projects. It's something we do under financial planning and management. Personal finance coaching is something that's coming up for us, and we are happy to tell our clients we do this. This is where we sit with you at a personal level. After you make all this money you've made from your business or from your employment or from other places, how do you manage your personal finances, your debt levels? How do you manage debt? Is debt a good thing or a bad thing? People talk about estate planning. How can I plan for the future? Should I invest in treasury bills, or should I be able to give my friend who wants to start off a car wash business? All that is under personal finance coaching. It's a whole different thing. If you check our website, you can always register with us for a session. We give you the first session for free, because at Mwalimu Biashara, we are interested in developing people. So we help you understand where you are at and determine where you can go from there. We've teamed up with other consultants who help us help a whole structure around human resource management and operations strategy. Our delivery structure is both in-house or open forums or group trainings like we have. But this last slide, why should you consider working with Mwalimu Biashara? It's because we have already established our niche. We know that most organizations have the right strategies, but the issue for you to stand out is how well you implement it. And that is our strength. We have carved out a niche that helps organizations put in place financial plans. And most importantly, you can execute them practically in your business. Our commitment is that for every session you have with Mwalimu Biashara, you leave with a practical explanation, practical application for your business. We can sit with you one-on-one and make this practical for your business. We've developed tools, tactics. I've already talked about an accounting system. I've talked about many tools we can give you, and they're very easy to use, so that you always live with something that you're going to use for yourself and your business. Lastly, I'll leave out our contacts. This is how to reach us. You can either send us an email, you can call us on that number, or you're free to go through our website and see more about us.